Hello, definitely everybody. So today's webinar is going to be one very good one, which are going to at the risk, especially when they're trading energies. So what I mean by energies, if you're trading like oil, you're trading gas, you're trading WTI, and the other. So the first thing that I have to mention here before I start is that in the forex market, the most important thing actually is what strategy one is using, but is the amount of risk one is willing to trade. So your money remains safe as long as you've not placed any trade on your chart. If you have something like this, assuming you have Brent oil, then this is a demo account. So assuming you have this, so far you have something like this in your account. This money is always very, very safe as long as you've not done anything on that account. So before you enter any trade, before you find yourself entering any trade, first of all, ask yourself, how much am I willing to risk in this trade? How much should I lose in this one? How much do I expect to get in this trade? So that if price goes against you, you know exactly what you're supposed to earn. If price goes for you, know exactly how much you're supposed to gain from that trade. This is the most important thing. This is always the most important step. Whatever strategy one is using, whether you're using engulfing, candles, in bars, whatever inside bar, whatever strategy one is using, the most important thing always is the amount of risk one is willing to put in a given trade. If you have this, assuming I have this one, I have a chart like this. Before I decide whether this is going to be a buy or a sell, first of all, understand that you have to know the amount of risk one is putting in a trade. Whatever you are willing to lose in that trade is really, really important. So how to do that? To understand the amount you're willing to risk properly, something you have to understand first of all. This thing I keep mentioning here is what is known as PIP value. PIP is the amount, like PIP is any slight move price, any slight change in price. It's known as a PIP. When price moves from this point, 64.86, goes up to 65.06, difference between these two, keep that bit, 86, 65.86, 86, this moves this distance, 5.665.86. If price moves this distance 1.00, this becomes the number of pips. So you take the difference between this, and then you get the number of pips. Then each pip has a value. That if you have, assuming place a sell here at the lower line at 64.6, then you have your stop loss here. The number of pips from this point to this point, each one individually has a value, and that value depends on the volume one is trading. If you're doing a volume of 1.0, it means that the number of pips, if this is 10 pips, from this point to this point are 10 pips, multiply 10 times this, and you get the amount of money you're going to lose in that trade. And if this is changed, assuming I change this to 0.1, I change 0.1, you realize that the amount of money risk from this point to this point is actually 1, which means if the number of pips from this point to this point is 10, that means that only 10 is lost when price moves from that point to this point here. So you have to learn how to work with lot size, work with pip value, and you have to get your trades correctly. And remember, as I said from the start, that you are not trading anything unless your screen shows you something perfect. So What I'm going to look at now is I'm going to look at a brief outlook of Brent oil. I'm also going to look at a brief outlook of other energies. Then we'll see exactly how you can enter trades, find such a simple strategy for risk management so that you get a good have this. This is Brent oil. The very first step towards having a proper risk management is to have a good strategy. That's the very first thing. You cannot have a good strategy in a good risk management if you don't have a good strategy. Start off with the monthly, and very first thing I'm seeing here, if I don't look at any other thing, is I put it very simple, that we have some candle that looks like a pin on the monthly chart. So this candle looks like a very good for a sell, which means that further the price is moving up this month. We are like 11 days into the month. The further the price is moving upwards, a very good sign that we're just retracing. So this here should be the correct place to sell from, because whoever sold at the beginning of this month actually had their stop loss above previous month's highest high, which is here. So some of them have been stopped already. If you want to trade correctly, wait for those places where you're supposed to place the stop loss. Enter on those places instead. That makes sense. But instead of entering trades early, that's if you see a pin bar and you know you're supposed to sell immediately, have your stop loss above that pin bar, don't sell right immediately. Instead, have your pending trade here, the tip, or at the place where you expect the stop loss to be at. Then you have your stop loss the same distance from this point to this point. So it's how many pips? From this point is 315 pips. So have your stop loss at around 315 pips above the tip of that candle. So it's around 15. So this is the first step. Understand what is happening at time. Very, very fast of all. Understand that we're supposed to go downwards. It's a sign that this is now a sell. Then the price begins to do something opposite of what you expect to be happening. Instead of trading immediately, wait for an unprecedented retracement. That is, if the price is supposed to proceed downwards, wait for price to immediately retrace to the upper side. Then when it is at the place where the stop loss is supposed to be at, that's when you begin to trade from that point. Because as we've seen here, if somebody actually sold immediately on the spin bar, price came up and took him out. If you sold at the tip of this candle or where the stop loss ought to have been, then add your stop loss here, the correct one. As you're speaking, the price is yet to come even close to this level here. So the first thing, we'll look at a brief overview, like an outlook. Have this very good trend line. Also have another trend line from the top. Is this? It's another very good trend resistance. It's a move the lower side, it came back, it's a resistance. Lower side, resistance, resistance, which means the upper trend line to the lower actually very significant. So the price comes to any of those levels, if the price come back to this level here, it's a buy. Price goes up to the trend line, that will give us a sell. As it is now, actually bounced off the lower trend line, which means the price should proceed upwards. Price should proceed upwards. Price needs to continue up to that. Bounce off from that point, proceed down. So the first thing we have to know exactly what to expect to be happening on. If you don't know what's happening on the monthly, there would be no need for you trying to trade what is happening on a lesser time frame. You have to understand very, very first of all whatever is happening on a higher time frame, such that if I have a sell monthly, that's if the month is showing me a sell and then daily chart is showing me a buy, know that the buy which you're seeing on the daily chart is actually a retracement on a higher time from the monthly chart. So you don't find yourself buying because the price is moving daily chart. You have to wait for time frames to agree. What I mean by agree is you have to, if you're seeing a sell on the monthly, the same sell must be on the weekly, the same sell must be on the daily, the same sell must be on 4 hours, the same sell should be on the 1 hour, such that if you have sell on the monthly, daily or 1 hour is showing you a buy, that buy could just be retracement. So wait for price to retrace up, break place to sell it from on the monthly, pick a sell, then you fix your stop loss on the monthly, not on the 1 hour. So if I have a sell here, assuming I'm expecting price to move, like in this case I had this one, this as a very good support. I was supposed to buy here. Add this one here. Stop loss, the correct place to place my stop loss is here, or the lowest low on the monthly. So if you are to scale down on a lesser time frame, when this was happening, when price was attempting to move downwards here, actually I've seen that the price was moving to the lower side like this, had this bounce, came up, and this was when the price was attempting to move to the lower side. So if you are to buy it, because monthly is a buy, look for a place of consistency. Place of consistency is where the price tends to bounce off from support. So have this as a support. So this could be the area of consistency. You already know very well that monthly is a buy. Instead of buying it based on what's happening on the monthly, wait for a place of consistency on the 1 hour chart. That way, find yourself entering at the lowest possible risk place. So if you know very well that monthly is a buy, scale down to a lesser time frame, look for an area of consistency on that lesser time frame. That is a very good place where most people are buying from on a lesser time frame. Buy it from that point, but instead of having a stop loss based on that lesser time frame, fix your stop loss based on the monthly, such that you're able to sell buy here. We actually will take a buy in between this place here, but stop loss is fixed same place where it's supposed to be on the monthly, this level here, or this level here should be the correct. So you find yourself entering trades correctly. You enter the lowest possible risk, have your stop loss here, take profits also fixed based on what's happening in the monthly, such that you pick a buy this level here. This is our stop loss. Take profit is automatically fixed somewhere around this point. So if you calculate the amount of risk you expect, whatever you're risking here, the amount of money you expect to get in that given trade, find that you are still better. It's how much? It's around 600. This around 300. Double. This is correct. Whatever we expect now to be happening is for price to proceed up to this level here, this trend line, bounce off that point, proceed down, then it should do maybe bounce again, bounce off again, sorry, bounce off, retrace back, we proceed to the upper side. This is what will likely happen, such that we'll have our levels here, we'll also have a level here. Then if price goes below same trend line we expect to be buying from, wait for retracement, or we can continue down, which means on the lower side actually expect price to go up to this support, this level. So buy it, wait for a break below, and even a break below where we put it from, pick a sell from that point up to these levels. These are the levels where we want price. So if you're that person who's looking at the monthly chart, do not find yourself trading when the price is in between any of this. When the price is between this point and this point here, don't do anything. But when the price is approaching or is currently around a key level, that's the place where you start trading from. So the very first step towards having a proper risk management is not even the strategy itself. It's to ensure that when your strategy tells you something, you stick to that one. Which means if this is the sell place and the price has not reached this place here, don't do anything. So that's the very first thing, because if you're that person who is risking 10% or 1% or 2% or whichever percentage risking in any trade, and you're trading anything, find yourself risking 10%, 2%, 2%, 2%. For price to reach here, you should have lost almost everything. But if that person is trading one thing, price reaches here, risk that 2%. If it goes against you, that's it. They'll wait for price to reach here. So you'll find that when you hit 2% here, assuming you have negative 2%, negative 2% maybe, come here, then the price goes for you here. And that one where price is gone for you, get plus 50%. Boosts you back to normal. So the first step, you have to understand exactly where you expect to trade from. Understand that you're going to sell when the price reaches point A, B, or point C. And unless the price reaches that point, you're not doing anything. So we'll the same chart, lesser time frame, Brent oil. So far we've seen what we expect to be happening. Moved weekly. Almost the same thing is happening the weekly, just that we have some trend line here. It's not there on the market. Then you also have one at the bottom. So as we've said, the level to sell from is the level to sell from. Price is currently around the same place where we expect to be selling from. So to trade this correctly, if you have a proper risk management, move to a lesser time frame. Look for an area of consistency. Area of consistency should be a resistance, a level being used for severally for the same reason. Have this as a resistance. Have something like this. This becomes our area of consistency, which means I expect a sell on monthly. Price is to move up. I only expect it to go up to this level here. This will give us the correct place to sell from. So if you are trading weekly, don't do anything when the price is around this level here. This is around somewhere 64.20, and with this one, if you're that person who is doing like you're risking 2% of account, have that 2% here only. That if price goes above, you leave the whole thing. It bounces off just the 2% and then you live with it. The stop loss needs to be above highest high you can see. It's this one, 64.5. This is where the stop loss should be at. So when working with this one, calculate the number of pips from this point, then know the pip value. It's a way somebody can calculate this one. If we understand certain things, you can do this manually to calculate the pip value. Create some simple script that does this for you. So we have this. We are doing a volume of 1. Pip value is 10. We are doing 0.1. Your pip value is 1, which means if the distance between this point up to this point, you multiply 30 times 1, which means you only expect to be risking 30. So if your account reads something like this, 2065, out of this 2065, only 30 USD is deducted from your account. This is a good strategy. If you are risking just a percentage, a very small percentage out of what you have, that makes you more successful. You have to understand that you are only trading when price gets to a key level. If the price does not get to that level, you're not. So if you have this level, expect to sell here. Have two places, don't only have this one. If you expect to sell there, price goes against you. That's if price goes upwards, of course we look for buy. But if price proceeds up without getting to that place, have an alternative, like something that will guide you on what to do next. So if price does not reach this level here, as I've said, if price does not go up to this point, next best place I'll wait is here. Basically just wait for price to break below that level. I'll expect it to go below retracement so that we can proceed even, which means that we'll have a sell also. If I don't sell it here, I still have the chance to sell it, but on price goes this level here. Sell it there. Stop loss should be above candle triggered this break below. So if your candle looks like this, candle which is breaking below, if it looks this, you should have your stop loss above it. Stop loss above it. Stop loss above it. This is the basis. So if you sell it here in between this range here, stop loss above this point here. And another thing, you notice that the amount of money you're willing to risk from this point to this point is bigger. Like if the number of pips here, you're risking 2% from this point up to this point, and you're risking 2%. Sure you work with this volume so the pip value properly. This is the only way you can make it trading. So the same thing applies to the others. I've not looked at gas already, not looked at this. The same thing applies to both of them. Sure you understand the value per pip. So now you see that gas actually is 10. If you're doing 0.1 value per pip for gas is 10. If you're doing Brent oil, value per pip is 1. It's a very big difference. So don't just calculate stop loss based on number of pips and then you value. You have to get the pip value inside your. Understand the value for each currency. Understand that anytime you enter any trade, you are not safe. Despite however good your strategy may be, you are not safe. Price moves your way. So you have to have a risk management strategy. Thank you. That should bring us to the end. Wrap this up. That should bring us to the end of this webinar. Again next week at the same time. So see you.